What's up, everybody? As we've seen in recent weeks, some very big banks have completely imploded. First, we had Silicon Valley Bank and Signature Bank of New York completely collapse, quickly followed by some very troubling news regarding Credit Suisse and First Republic. If you worked in real estate back in 2008 like I did, you probably dropped your coffee and felt cold all over like I did. There's only a few times in my life that I felt this way, and this was one of them. I honestly will never forget the day that Lehman Brothers closed. It felt like the housing market took an immediate nosedive into the abyss, followed by foreclosures and short sales, and would take years before it would really start to recover. So are we back in 2008? Is this now finally the big crash that people have been warning about? How exactly will these bank failures impact the future of the housing market? Well, today we're going to take a deep dive and see what the industry insiders are saying. We'll take a look at articles from Zillow, the National Association of Realtors, and Redfin to get their different perspectives. And of course, I'll chime in with my opinion as well. So let's just dive right in. Lawrence Yun, the chief economist of the National Association of Realtors, said, Silicon Valley Bank failure, along with a few other banks, means that the Federal Reserve cannot be so aggressive in raising its short-term interest rates. Therefore, mortgage rates will decline. The average 30-year fixed mortgage rate did go down to 6.6% for the week ending March 16th, according to Freddie Mac data. But is it as simple as that? Zillow chief economist Skyler Olsen goes a little deeper with two predictions on how the shutdown of Silicon Valley Bank could impact the housing market in 2023. Her first prediction coincides with Yoon's, and that she believes that the heightened economic risk is likely to bring a short-term boost to the housing market by way of lower mortgage rates. She explains that the Federal Reserve may rethink raising interest rates due to the uncertainty caused by the failing bank. In addition, investors tend to put their money towards safer assets, which tends to be U.S. Treasury notes and bonds. Mortgage rates lately have tended to follow the movement of Treasury yields, which are falling. If rates do continue to go down, it does stand to reason that the housing market will heat up. Home buyers have been very responsive to mortgage rates in recent months. When rates climbed back above 7% earlier this month, it stifled momentum that had been building as rates originally drifted down to start the year. Today, falling mortgage rates could thaw what was shaping up to be a fairly frozen spring home shopping season. Well, we definitely saw a bump in buyer activity at the beginning of the year when rates went down, and also last week when rates dropped. Mortgage purchase applications jumped 7% for the week ending March 10th compared to the previous week, according to data from the Mortgage Bankers Association. But they were still down 38% year over year. Lower rates would definitely help those buyers who are stretched thin when it comes to affordability, which we really need right now. Home prices have simply not come down enough to support local incomes in most markets in our country. The affordability crisis is real, especially for first-time home buyers. But there's more to the story. The collapse of SVP and the other banks could be a warning shot that a recession is imminent. Olsen writes, if SVP's trouble are indicative of wider issues, a coming recession could be deeper and longer lasting than expected. That raises the odds that income or job loss could start affecting housing markets where the economic stress is concentrated. Which leads us to our next prediction, which is the tech hubs should brace for more pain in the wake of Silicon Valley Bank's collapse. Olsen believes that tech-dominated housing markets like San Francisco, Boise, and Seattle will feel this the hardest. Businesses that were reliant on funding from SVB and others may lack capital to continue its business or have to cut back. This could result in job losses, especially with tech companies. Dana Anderson writes in the latest Redfin housing market update, housing markets in the Bay Area and New York, home to the 3 regional banks that have tumbled over the last week, along with many tech workers who have been laid off or are worried they will be laid off, are already feeling the pain. And Olsen writes, with fewer home buyers in these markets able to afford the elevated prices that have been supported over the years by high incomes and stock growth, it's likely these markets would chill and prices would come down. These markets have already seen some pretty heavy price corrections since the market changed last year. And if people start losing their jobs on top of our already bad affordability crisis, this correction could get a lot worse. Some buyers are canceling their contracts or bowing out of their home search because they work in tech and are afraid of losing their job. Bay Area Redfin manager Shelly Roca said in a statement, "The surge in tech layoffs was already causing jitters, and now the bank failures are adding to the buyer's nerve." According to Redfin's data, San Jose's home prices fell 17% year over year in February. This marks the biggest price decline in the metro since Redfin started collecting its data back in 2015. Prices were down 11% in San Francisco and Oakland, with Sacramento dropping nearly 9% year over year. In fact, Austin was the only metro outside of the Greater Bay Area to break into the top 5. The Bay Area also had some of the biggest declines in new home listings, as the drop in home prices caused homeowners to take their homes off the market or simply not bring them on at all. New listings fell by nearly 50% in Sacramento year over year, and listings dropped more than 40% in San Francisco, Oakland, and San Jose. It's pretty clear that those tech-heavy markets are heading for some very challenging months ahead, which could then permeate throughout the rest of the country. But for buyers in the market right now, a reduction in interest rates is a welcome boost to affordability. But they still should prepare for rate volatility ahead. And as for sellers, well, lower rates may give them that push they need to put their homes on the market, which would help with our inventory problem. But this is all short-term thinking. I honestly don't believe that the fallout from these bank failures is over. Back in 2008, I honestly felt like I lost my job overnight. It was that drastic. I had 2 little kids at home, and selling real estate was my sole source of income. Add to that, my house lost 20% of its value between 2007 and 2009. It was terrifying, but we did get through it. It was brutal and challenging, but perseverance and a bit of survival mode prevailed. And although I did get shivers up my spine the day that Silicon Valley Bank collapsed, in the weeks since then, I just don't think this is going to be the same. Zillow's Olsen advises, buyers today should be looking to put down roots and find a home that they're gonna keep for at least the next several years in case it takes a while to build equity. And I'll add to that, if you are buying today, just plan on staying at least 5 to 10 years, or better yet, 7 to 10. If you do have a long-term mindset, you can take advantage of these lower rates, and you're going to be buying in a market where there's a lot less competition. I'm happy I kept my house back when things were rough. It's where my family has created all our memories. And if I do choose to sell in the future, the investment will definitely pay off. Let's pivot and look at some Redfin data for the housing market for the 4-week period ending March 12th, and I'll give you my interpretation as well. The median sale price was $355,668, down 1.8% from a year earlier. That's the biggest decline in at least a decade, according to Redfin's monthly data set, which goes back through 2012. They go on to clarify that the median sales price fell in 24 of 50 of the most populous U.S. metros, with the biggest drops in the California cities we spoke about. Pending home sales were down 17.1% year over year. This is not surprising, as that the number of transactions is just lower across the board. New listings of homes fell 22.1% year over year, the biggest decline in nearly 3 months. New listings declined in all but one of the 50 most populous U.S. metros, with the biggest declines in Milwaukee, down 65% year over year, Sacramento down 48.1%, Oakland down 45.9%, San Francisco down 42.6%, and San Jose down 41.8%. They increased 2.6% in Nashville. It's so interesting that new listings have increased in Nashville. I just put a video out on Thursday about the most cheapest states to live in our country now in 2023, and Nashville made the top 10, so something to consider. Active listings, the number of homes for sale at any given time during this period, were up 16.5% from a year earlier, the smallest increase in 3 months. All this says is that homes are taking longer to sell. But since this is the smallest decline in 3 months, it does say that buyer activity is increasing. Homes that sold were on the market for a median of 46 days. That's up from 27 days a year earlier, and the record low of 18 days set in May. On average, 4.9% of homes for sale each week had a price drop, up from 2% a year earlier. Months of supply, the balance between supply and demand, was 3 months, down from 4 months a month earlier and up from 1.9 months a year earlier. So inventory is down from a month ago and buyer activity is up, which I think is really normal for this time of year since the spring market is the busiest. These are just interesting times, and the next few months will be very telling. But the best way that we can all see what's happening in our housing market is if you guys comment below. Tell us where you live and tell us what you're seeing in real time. That's just the best way we can really understand what's happening in the market. As I always say, real estate is very localized, and where I am in the DC, Montgomery County, Maryland, Northern Virginia area, things are still very hot and there are still a lot of homes selling with multiple offers. So tell us where you live and tell us what's happening. And if you want to talk more about the housing market, or if you're planning on moving to Maryland, DC, or Northern Virginia, and you would like our help, just send us an email. We'll set up a Zoom. We'll get you started. And if you want to see some other perspectives on the housing market, check out these next 2 videos. They're all from different industry insiders. Thanks for watching. I do appreciate it. Bye.